All right, so we're back. So far, what we've done, we've created a partnership or an LLC. We dissolved a partnership or LLC. What we're doing is we're going to liquidate a partnership. Liquidation is basically we're closing up shop. All right, the business is no longer going to be doing what it used to do. All right, and we're all going our separate ways, and so we need to get our investments out. Okay, so when a partnership goes out of business, it sells all the assets, it pays all their creditors, and then distributes whatever's left. All right. So what's great about this, the beginning of the semester, we started off talking about the accounting equation. All right. Well, we're back to the accounting equation again. All right. All right. And so what we're going to do is we're going to convert all those assets into cash. All right. We're going to use that cash to pay off our creditors. And in the end, everything balances. All right. And so, yeah, that's one of the reasons why I love accounting. All right. Is because it's, you know that you've done things right or you've done things wrong. Because if they don't balance, you did something wrong. All right. And so when a partnership goes out of business, the normal operations are discontinued. All right. So we close our doors. The accounts should be adjusted and closed. All right. So we're already, recorded all the revenues, expenses. We've closed those to the capital balances. The only thing that we have left, all right, are assets, liabilities, and owner's equity. So there's a 4-step process to the liquidation. Again, I want to point out, because some of the questions on the final exam are really trying to determine, do you know the difference between a liquidation and a dissolving of a partnership? All right, so this is a liquidation. First of all, we're going to sell all the partnership assets. All right, this is called realization. All right, realization is because we're realizing, okay, what the true value of all of our assets are. Okay? And so we record it, right, for what they actually are worth. When we convert something into cash, we realize, right, the value of that asset. Then we're going to distribute, right, from the sale of those assets, any gains or losses, right, based on the income sharing ratio. Okay? And again, that information comes from the partnership agreement. Then we're going to pay all of our creditors off. Okay? And then we're going to distribute, right? And this is important. Okay, it's not based on the income sharing ratio, but it's based, that's not what I was hoping to have. All right. It's based, okay, on their capital accounts. Okay. Because we're paying them off. They have a claim. If you remember, capital balances were the claim that the owners have on the assets of the business. And so here's a pretty picture. All right. And so assume that Farley, Green, and Hall decide to liquidate their partnership. Hopefully you guys realize that, Farley, Green, and Hall are actually all comedians, right? Chris Farley, Seth Green, and Arsenio Hall. Okay. They don't use their first names, but yeah, whatever. Just interesting. All right. And so, they've closed all their accounts. This is the post-closing trial balance. All right. And so we have cash, we have non-cash assets. And so in the real world, we have those listed: buildings, equipment, blah, blah, blah. All right. And then we have the liabilities and, the capital balances of Gene, Brad, and Alice. All right. And so the first thing we're going to do, all right, is we're going to sell all of the assets. All right. And so we sell the assets in this first scenario for $72,000. If you remember, okay, they were 64 book value. All right. And so that means we end up with an $8,000 gain. We're going to split that $8,000 gain between Farley, Green, and Hall based on their 50, 30, and 20, all right, ratio. Okay. All liabilities are paid at one time. All right. Non-cash assets and liabilities will be used as account titles in place of the various accounts that I mentioned before. Okay. And so, all right, step one, all right, we're going to, debit cash for 72. We're going to reduce our assets for 64, and we're going to have a gain, all right, of $8,000. Then we're going to divide that based on their partnership agreements. All right, we're going to pay off what we owe, and then, all right, we're going to distribute the remaining $74,000, right, to the owners, not based on the partnership agreement, not based on this 5-2-3-2-1, or I'm sorry, 5-3-2, okay, but on their capital balances. And so the best way to look at it, again, is our accounting equation. All right, so we have our assets equal our liabilities and our owner's equity. Okay, and so the first scenario, okay, we start off with the post-closing trial balance. We sell, okay, we're going to see the journal entries here in a minute. Okay, we sell those assets, all right, for $72,000. Okay, we divide, all right, the gain among the owners based on their partnership agreement. Okay. We take from the $83,000 now in cash, we pay off our liabilities. And then, wow, isn't that cool, all right, that we have $74,000 in cash and we owe $74,000 to our owners. Oh, isn't that nice and clean? Doesn't that give you a sense of, woohoo, all right? I did it right, all right, because now we can all go our separate ways. Right? So the journal entries, all right, we're going to get our cash, we're going to reduce our assets, we have the gain. We allocate the gain based on their partnership agreements. We pay off our liabilities, and then we pay the owners what is owed them. Again, the only thing that is different when it comes to an LLC, all right, is the account title that we use. So, all right, let's look at if we take a loss, all right? And so we didn't sell those fixed assets for more than book value. We sold them for less, okay? And so in this case, all non-cash assets are sold in a single transaction for $44,000. Remember, they had a book value of $64,000. That means we ended up with this loss, okay, of $20,000. Okay. We're going to allocate that loss based on their partnership agreement. So Farley's going to get $10,000 of that, all right? And yeah, whatever, 30% of, yeah. All right, the rest goes to Green and Hall. We'll see that in a second. So we go through the same transactions, all right? And so you can see again here, instead of the $64,000, all right, we only get 44 from that. So we allocate, all right, the the $20,000 difference. 50% is going to Farley, 30% is going to Green, 20% of it is going to Hall. All right. We still thankfully have enough money, all right, to pay off our creditors, all right. And so that's what we do is we pay off our liabilities. That journal entry is no different, okay? And then we're left with $46,000 and capital balances equaling $46,000, right? So it works out perfectly. Right? We can all go our happy way. Okay. So the journal entries, right? We took a loss instead of a gain on the previous example, okay? We allocate that loss, all right, to the owners based on their partnership agreement. Okay. We pay off our liabilities, no different. And then we allocate the cash to the owners, not based on the partnership agreement, but based on their capital balance. Easy enough? Yeah. Okay. So, when we have a deficiency, right? A deficiency can happen only, all right, through continuous losses or when somebody's capital balance goes into the negative, all right? And so that's what we're going to do in this scenario, okay? So again, same owners, okay? But this time, okay, we only sell, all right, for $10,000. That's those assets of $64,000, we only sell for 10 grand. Why? Maybe because we really want to go our separate ways, and so it's a fire sale, all right? So pennies on the dollar, all right? We end up with a loss, okay, of 54. Okay? And so, again, Farley is going to take half of that, all right, which will ultimately put him in a negative capital balance, all right? So, if they have a larger ownership, all right, or a larger stake, in this business. Okay? He benefited when they, made money. Okay, but now he's getting, hurt more because they're losing more money. Then the journal entries, with one exception, pretty much stay the same. Okay? And so, again, all right, we end up here with a $54,000 loss. Okay? Half of it, all right, goes to Farley. Okay, 30% of it goes to Green. Right, and that's where it puts Farley at $5,000. Okay. Now, if Farley, and this is what happened in this scenario, if Farley is a good guy, all right, then he's going to say, hey, because see, Green and Hall have claims on the assets of, what is that, $17,000. Okay. However, there's only $12,000 there. Okay, so they're not getting what they're supposed to get unless Farley, and in this scenario, he contributes. This is what's new. He contributes an additional $5,000. Right? You know why? Because when Green and Hall went into business with Farley, they realized that this guy has morals. All right, that he's a good guy, and if anything bad were to happen, he's going to step in and take care of it, and he did. All right, he contributed an additional $5,000 so that, right, his capital balance is now zero, and Green and Hall can get what is owed them. And so again, the journal entries, right, the huge loss. Okay, the loss is then allocated based on the partnership agreement. Okay? We still have enough cash to pay off our creditors, right? And if we didn't, this is a scenario where we end up being going into bankruptcy. All right, bankruptcy is when you don't have enough assets to pay off your creditors. In this case, we did. Right, thank goodness. All right, Gene Farley was a good person, right, and they contributed the additional $5,000 that they owed to the partnership, so that Brad and Alice can get paid. If the deficit of the partner does not pay, okay, ooh, so he's a loser, okay, ooh, I don't want that. All right. If they do not pay, there we go. The other two partners don't want to just wait around. All right, they can theoretically take Farley to court, all right, and sue him. They have the legal right to do that. However, if this business has been losing money for years, that's why you're selling it for so cheap. Maybe they don't have any money. Okay, and so in a lot of cases, it's not worth it to take them to small claims court, right, to get the $5,000. And so what they decide to do, the two remaining partners, all right, is, that's a loss, right? Okay. And so they divide that loss, again, based on the partnership agreement, okay, the remaining partners, right, agreement, and then they can get the remaining cash and go their own ways. Okay. And so that's what's happening here, all right? So assume that in the preceding example, Farley could not pay their deficiency. The deficiency would be allocated to Green and Hall based on their income sharing ratio. Because if you remember, it was 5 to 3 to 2. Right. Well, Farley's gone. All right. So now it's just 3 to 2. Right? Or 3/5 and 2/5. Okay. And so they're going to divide that. All right. That $5,000. Okay, this is the deficiency. They're going to divide it. All right. 3/5 and 2/5. I guess it's down here. And so that reduces their capital balances down, okay, from 5,800 to 2,800, 11,002 to 9,002. Okay. So it kind of looks like Hall, even though they had the smaller ratio, made out in this scenario, right? Because it didn't absorb as much of the loss as the other partners did. And so the journal entry, okay, they're reducing the capital, her capital, and they're splitting it, right, among the two remaining partners. then they can pay out, all right, the cash that remains, okay, based on not the partnership agreement, but again, based on their capital balance. And so, how do we report this? Okay, so the changes in partners' capital accounts, all right, are going to look just like the owner's equity statement, right, that we talked about the sole proprietor, except now instead of having one person, one capital account, we have multiple capital accounts. All right, and so this is just a statement of partnership equity, like owner's equity. All right, you know, yeah, if it was an LLC, it would be members equity. Okay, but it's going to look like this. All right, so before we just had one person. All right, we had the beginning. We had additional capital contributions, the net income, the draws, okay, their ending balances. But in this case, we have it for the partnership as a whole, okay. So this would be reported, on the balance sheet, all right, as the owner's equity. Okay. So hey, great job! You guys made it all the way through Accounting 201. Congratulations. By just looking, let's see, we had 1, 2, 3, 4 people didn't even show up. And some of those haven't showed up for going all the way back to March 3rd. All right, and so we've lost people along the way, but you guys really stuck it out. Good job. Yes. Thursday, we will just, actually, let me stop this, stop the recording.